Now, this transaction is a Sukuk al-Musharakah, and this was the structure that we used when Dubai Ports was buying P&O, the shipping company. That purchase cost about $10 billion, I think, and $6.5 billion was funded by banks, and $3.5 billion was going to be funded through the Islamic markets by issuing a Sukuk for $3.5 billion. The problem was that Dubai Ports didn't have assets that were worth $3.5 billion. They were not allowed to sell the land at the port. That was state-owned. They didn't have ownership of it. And we all scratched around trying to find some assets that could be worth that, and there weren't any. And at about 2 a.m, somebody came in and they said they had found some assets, and those assets were cranes. I don't know if any of you have seen port cranes. They're very big, but they're not going to be worth $3.5 billion, no matter how hard you try and pretend they are. And then someone had a really bright idea, which was it wasn't just the cranes that could go into the structure, it was the right to use the cranes at Jebel Ali Port. And that right to use cranes was a right owned by the state, which the state was willing to transfer. And that right, they felt, could be worth anything. So we decided that usufruct right, the right to use, and the cranes themselves, situated at the port, was worth $1.5 billion. And so Dubai Ports, one of their entities, PCFC, which was the entity we were dealing with, contributed its physical asset, the cranes plus the right to use them. And the SPV here contributed the issue proceeds, this is $3.5 billion, into a Musharakah, and they entered into a joint venture. And the idea was that the joint venture would use the cranes and the cash proceeds from the Sukuk issue and make profits that were going to be paid to these investors. And that was an acceptable structure. There are lots of other things here that you don't need to worry too much about, like share pledges. And Dubai Ports, which I call PCFC, was the obligor. It provided the purchase undertaking. So if there was a problem down here, Dubai Ports would buy out the units, all the units in the Musharakah. And once the issuer had sold its units in the Musharakah, it would receive back the $3.5 billion, which was its contribution to the Musharakah, and pay off its investors. Now, it had a novel development here, which was the transaction administrator. In the previous slide with DCA, you saw that we have an issuer trustee. The issuer says, I've acquired these assets, I'm going to declare a trust over them, and I'm going to hold them for you, the investors, which sounds great. But when things go wrong, this is just an SPV. Are we going to believe, if you're an investor, are you going to believe that this SPV is going to represent your rights and enforce the rights that it has to the underlying assets, or more importantly, the purchase undertaking against real, strong third parties like the Dubai government? And the view, by the time we'd moved on to the P&O transaction, was that that was unlikely. And so the transaction administrator, which in this case was Deutsche Bank, an entity used to being a trustee, was appointed, and its job was to administer the trustee functions that the issuer had acquired. This role has really developed and has become much, much more important. It's now called a delegate, and it's the delegate that is having to enforce Sukuk that have defaulted. ABAR was an Abu Dhabi-based petrol company which wanted to raise some funding to buy a Singaporean company. And it didn't have any assets at all that it felt it could put into the structure. And so we came up with a Mudarabah structure, a trust participation financing, where the SPV, ABAR Sukuk Limited, issued Sukuk, which raised $460 million, and only that $460 million was given to ABAR Petroleum as the Mudarib. And it was the Mudarib's job to use this money in accordance with the business plan which was outlined to make profits for the investors, and these were the investors. And what they were going to do was to use this cash to buy the Singaporean company that they needed to buy, and they believed that that would bring sort of so much return to their structure and their business that they would be able to pay the investors the amounts, the pre-agreed amounts that were set out in the documentation. Now, people loved this structure because it meant suddenly you were not tying up any assets at all. But last February, the scholars felt that the structure was being abused, that people weren't really raising money and complying with a detailed business plan. What they were doing was raising money and using it as ordinary working capital. And this was sort of the first Mudarabah Sukuk, but as they developed, the business descriptions became less and less detailed until you ended up with 2 lines, which basically said, we'll use it as part of our ongoing business, and we believe that will make sufficient profits for you. So when Taqi Osmani in November 2007 said that he thought 2/3 of Sukuk in the market were not Sharia compliant, he actually, that's how it's been quoted in the press, what he actually said was, what he was referring to were Mudarabah Sukuk primarily, but also Musharakah and Wakala Sukuk, because these are supposed to be equity-like structures. You are supposed to be taking a risk on your investment. And what the purchase undertaking did, and this has got a purchase undertaking as well, was to say, if something goes wrong with this investment, we, the provider of the purchase undertaking, which here again is Avar Petroleum, will guarantee to you that we will repay you the principal amount that's due to your Sukuk holders, plus any accrued return that they haven't received yet, plus any expenses that might be there. There was no risk at all other than the credit risk that you're taking here on Avar Petroleum. And what the scholars said, and then there was a formal statement on Sukuk that AOFI issued in February 2008, was that you could have a purchase undertaking, you just couldn't fix the price at the time that the transaction was entered into. The purchase undertaking would have to be exercised at a price that was agreed at the time of the exercise or by reference to market value. And that has given the market a big problem, because the market treats these as fixed income instruments, and investors in Sukuk are like investors in bonds. They want to know what their return is going to be, and they want a guarantee that they're going to get their principal back. This is not an equity play for them, and the reason it isn't is because they're getting debt-like returns, and they don't want to take equity-like risk. And that has been sort of a huge problem, and to some extent I feel we've been able to park that problem because the financial crisis took over. Very few Sukuk were issued, and so one of the interesting things about the upturn in the market now is that we're going to have to go back and we're going to have to find a solution for this. And for people to say, well, these are equity-like instruments, you should be taking a risk on the underlying assets, I think that's fine in theory. I'm just not sure that investors will be out there in the market who are willing to do that, in which case there will be a lot of Sharia-compliant companies who won't be able to raise the money that they need.